Bring in now Kristina Hooper, Chief Global Market Strategist at Invesco. Welcome back. It's nice to see you as well. Rick's point today is that I think this market's full, right? The multiples expanded. The market's come back a tremendous amount since last Monday. Agree or disagree?
Well, certainly it's come back a lot. I think it speaks to the resilience of the environment, but I do agree that there could very well be significant volatility ahead. We could see some pullbacks. I just don't think that's a reason to take profits off the table, given how much cash is sitting on the sidelines for investors.
Sure, but that's not the reason that he necessarily suggested you should. It was more towards the valuation of this market is now stretched. Like, all of the good news is in. How do you respond to that?
I don't think all of the good news is in. When we look at the forecast for earnings growth for the coming year, it's pretty good. And you have to factor in that there are more names in the S&P 500 that are potentially contributing to that growth. At least that's the expectation. So it's not just a few names, it's more of the S&P 500. I think that matters. I do agree that it's very important to be well diversified. And this is an attractive environment for fixed income, no doubt. And I would want adequate exposure there. To me, it's all about diversification. But I think it's important to maintain significant exposure to equities.
But how would you look? I mean, over the long term, he said it himself. Did Rick Reeder? A year from now, equities are still going to be higher. But that doesn't mean that there's going to be some choppy waters ahead. Do you think that earnings justify where the multiple of this market currently is? Because I think he would cast some doubt on that based on the commentary and the forward guidance from several companies.
If we get rate cuts and they start soon and they're significant, I do believe that that would be the case.
Okay. If you were going to, do you take issue with the idea that you should trim some mega cap tech stocks right now, given the fact that they've snapped back so sharply?
Well, what I think the market is telling us right now is there's a higher probability of a recession, which means you want to be in some defensive names. Arguably, those mega cap tech names with the significant free cash flow generation are checking that box. So I wouldn't abandon them. I might trim them a little bit, but for the most part, I think it's time to just take some cash from the sidelines, add to fixed income exposure, add to alternatives exposure, so there's more diversification and a more smoothing of volatility, because there are likely to be some ups and downs going forward.